What's up, everybody, and welcome to Killing the Points Game. My name is Blake Martin, and the average credit score in America is between 673 and 695. Now, you might be thinking to yourself, I'm killing it, my credit score is 750. Or you might be thinking, ooh, yikes. Well, that's what this video is about. Everyone wants to improve their credit score. Now, whether you want a new credit card, or a new car, or apply for a mortgage, anything that involves a new line of credit, those lenders are going to be looking at a bunch of different things, and one of the biggest things is your credit score. Basically, the banks are thinking, if I lend the money, will they pay it back? In this video, I'm going to help you understand what your credit scores are, yes, multiple credit scores are, and a step-by-step guide on how to improve them. But before I get started, please like the video, subscribe to the channel, hit that notification bell so you can be notified whenever I make new videos. Also, please comment on the video if you have any questions or comments as you go through. Definitely let me know. I try to respond to many of those as possible. Also, check out the Killing the Points Game Facebook group, link in the description, and also check out my disclaimer down there as well. So as I mentioned, you do have multiple credit scores. They're usually pretty close to each other. However, depending on whether the lender that you're working with actually reports to all three credit bureaus or not, each score is actually going to be a little bit different. So that brings us to the big three: Equifax, TransUnion, and Experian. These are the three major credit bureaus that all lenders report to. You're probably familiar with the educational scores that you can get by checking websites like Credit Karma, NerdWallet, your bank, or through some of your credit cards that will give you what they call your credit score. Equifax, TransUnion, and Experian all have proprietary algorithms that basically allow them to get a somewhat clear picture of what your credit score might look like. However, as I mentioned, these are just educational scores. These scores can give you a decent picture into what a lender might see if they pull your credit when you're applying for a new type of credit card or loan or something like that. However, these are not actually the scores that the lenders will see themselves. And if you didn't know that, like the video, because I'm about to tell you what most likely lenders are pulling. Most creditors or lenders that are pulling your credit are most likely pulling your FICO score or maybe your Vantage score. These scores are meant to tell the lender what your credit worthiness is and how risky it is for them to actually lend you money. Current versions of the FICO scores and Vantage scores range between 300 and 850. The FICO score has been around since about 1989, and they still claim to this day that about 90% of top lenders use their scores to determine your credit worthiness. There have been many iterations of the FICO score. Currently, what's being used most is either FICO 8 or FICO 9. The FICO 10 score is coming summer of 2020, and it is going to aim to give even a clearer picture to lenders of how risky you are to lend money to. FICO actually has different score types depending on the type of lending. So they have a regular FICO score, the FICO bank card score, which is what many creditors will pull before you're approved for a new credit card. There's also the FICO auto score if you're applying for a loan for a vehicle. Now, the Vantage score is something that you might not have heard of, or maybe you've seen it online. It's only been around since 2006, and it's actually a joint venture, a collaboration between Equifax, TransUnion, and Experian to basically come up with a similar score to the FICO score, but under slightly different parameters and a different algorithm. Vantage Score 4.0 was released in 2017, and that is still the current version today that lenders are using. The Vantage score has gained some footing. From the summer of 2017 to the summer of 2018, it claims that it has been used by over 2,500 financial institutions for more than 10.5 billion pulls of your credit score or your Vantage score. Now, if you didn't know what a Vantage score was, like the video because I'm about to tell you. The fact of the matter is that lenders can pull from quite a variety of sources to get your credit scores, your educational scores, from the separate credit bureaus, or your FICO score, or your Vantage score. But what we really need to know is what affects these scores. So lucky for us, it's been made very easy to figure out what affects our FICO scores and Vantage scores. So we're going to start with FICO scores here. I'll try to get through this quickly. So 35% of your FICO score is comprised by payment history. Now that's whether you make a minimum payment or satisfy a full statement. As long as that payment's on time, we satisfy this portion of FICO score. The next is amounts owed. So FICO breaks this down into 5 categories here, or factors. That is the amount owed on all your accounts, the amount owed on different types of accounts. They're going to look at what types of different accounts you actually have that you owe on, how many accounts have balances, credit utilization ratio on revolving accounts. So this is the amount that you use versus the amount of actual credit limit that you have. So we actually want that to be lower. And the amount of the installment loan that's still owed compared to the original. So your principal amount versus how much you still owe on that loan. Obviously, we want this to be a lower amount. So we'll go back to the chart here. The next highest is 15% for length of credit history. They break this down into 3 little bullet points here. How long your credit accounts have been open, including your age of the oldest account, age of your newest account, and the age of all of your accounts. How long specific credit accounts have been open, as well as how long it has been since the account has been used. So obviously we don't want to leave accounts dormant. Going back to the chart here, we've got 10% for credit mix. So it actually does look good and actually will raise our FICO scores by having different types of loans, whether it's mortgages, car loans, student loans, credit cards, all these different types of things that you would achieve through a lender. That mix will actually affect your FICO score in a positive way. Now this is one that will actually affect your score actually more of a negative way, having too many sources of new credit. So if you go out and apply for 4 new credit cards in a month, that's going to show that you're desperate. It's going to show that you're high risk. If you all of a sudden buy 3 cars and open up 3 credit cards, that's not going to look good. So that's your FICO score. Moving on to Vantage score. So this actually, NerdWallet actually made this really simple by giving us this pie chart again here. So we'll break this down. 40% on for payment history. Again, same as FICO score. So if you're catching a trend here, the most important thing for your credit scores, whether it's your FICO score, Vantage score, or just your separate educational scores from the different credit bureaus, is always payment history, so pay on time. 21% here is for depth of credit. This is that mix of credit, right? We want to have as many different types of credit as possible that are all kept in good standing. 20% for utilization, so this is that amount of our credit that our credit limit that we're using or that we utilize. So we actually want to use less of our available credit, which we can help by doing a few different things I'll go over in a little bit. So the balances here is 11%, so just the amount that we still owe on our debts. Recent credit applications, so we're down to 5% here, so again, not a big deal, but it does matter. New applications for new types of credit cards or loans, that is going to affect your Vantage score. And then the smallest piece of the pie here at 3% available credit. So this is, of the amount that we actually have, how much is available. So that does affect our score in a small way as well. So now that we know what affects our credit scores, here are 10 things that we can do to improve our credit scores. Number 1, solve any delinquencies, late payments, or accounts in collections. Number 2, check your credit reports with the 3 major credit bureaus, Equifax, TransUnion, and Experian. Look for any errors, and if you do find any, dispute those with each separate bureau. Number 3, and this might sound like a simple thing, but surprisingly, this is one of the highest causes for lower credit scores, is to pay your statements on time. Even if it's just the minimum balance, as long as you make a payment that satisfies at least the minimum balance on your credit cards, anywhere between the minimum balance and paying the statement in full will satisfy as a payment on time, and that 35% for FICO score or the 40% for your Vantage score will be fully satisfied, and the biggest portion of your credit scores will be 100%. Number 4, maintain as low of a utilization of your lines of credit as possible. I typically try to stay under 10%. Now there's a trick here. As long as you make a payment that satisfies most or all of what is going to be due on a statement, what the credit bureaus actually see, what is reported to them, is the amount on your statement. So say you have a $10,000 credit limit on a card and you charged $5,000 on it, right? So that would be a 50% utilization. Again, we want to try to stay under 10%. Well, as long as you pay off at least $4,000 of that $5,000 before the statement posts, then the statement is actually going to post with a balance of $1,000. So we want to just pay as much of it off before the statement posts. That way, what's actually on record is as low of a number as possible. Number 5 is something that takes some time. However, it's a good thing to keep in mind as you continue down your credit journey. It's a mix of credit types. So we want to have as many different types of accounts that are all in good standing as possible. This is going to help all of our scores, whether it be credit cards, auto loans, student loans, mortgages, personal loans, any kind of loan that you've gotten from a lender. As long as we have a good diversity of these different types of lines of credit and they are all in good standing, that is going to help all of our scores drastically. So number 6 kind of falls in a little bit of a gray area. Basically, don't have too little accounts or too many accounts. If you've only got one line of credit, there's very little things that can be actually sourced when a lender is looking to pull your credit. So chances are your credit is going to be lower if you have very few lines of credit. A similar problem can happen if we have too many accounts. If we have a bunch of credit cards, a bunch of auto loans, multiple mortgages, student loans, personal loans, many of which might not be all kept up to date. We've got payments that are late, things like that. Too many different types of accounts that are not all kept in good standing will affect our credit score in a negative way. Number 7, pay off debts as quickly as possible. We want our amounts owed to be as little as possible by comparison to the original principal balance of whatever the loan was that you were approved for. Now, a good trick here is to pay off the debts that have a higher amount still owed by comparison to the original principal. We want the average ratio of the amounts owed to our original principals to be as low as possible. So any that you owe more on, make sure to pay those down first. Number 8, the longer that your credit history with an institution has been healthy, the better. So think twice about closing that old credit card. And if you are going to close an old credit card, or any credit card for that matter, make sure that you try to first transfer over as much of your credit limit on that card to another card within that same lender. So if you have, say, 3 different Chase credit cards and you're looking at closing one of them, call up Chase and ask them if you can transfer your credit limit from the card that you're going to close. Sometimes they'll only let you do up to like 80% of the actual full credit line on that card, but transfer as much of that over to one of the other 2 cards that you have, because this will keep your credit card utilization within Chase at a lower percentage. Number 9, don't apply for too many new lines of credit all at once. These are most likely all going to result in a hard pull on your credit, which does actually affect our credit score in a negative way for a short period of time. Most likely it's also going to shorten your age of your credit history. It just kind of makes you look risky to other lenders. And number 10, last but not least, ask for credit line increases. So whether you're opening a new card or you have cards that you've had open for quite some time, call every once in a while and ask for a credit line increase. This will lower your utilization, and as long as it doesn't result in a hard pull, over time it will raise your credit score. All right, now a few common credit myths. I hear this one all the time. Leaving a balance on a credit card and proving over time that you can make payments consistently. This does not help your credit score. Making payments on time does help your credit score, but leaving a balance on that card, all that is going to do is cost you interest, and having a balance remain from month to month does not help your credit score. Now, the second myth is really more a matter of clarity, and it involves charge cards. Cards like the green and gold and platinum cards from American Express. Now, these are charge cards, not credit cards. So there's not actually a listed credit line. Therefore, these cards will not affect your utilization. So if you're a new borrower, we actually want actual credit cards, not charge cards, so that we can build our credit over time. We do want to have numbers on record that is reported to these bureaus so that our utilization can be proven to be low. Now, these cards obviously do show a length of time that you've had the card and payments on time, things like that. So it's not like they don't affect your credit score at all. They most definitely do. However, given that one of the biggest factors of building your credit score is your utilization, these cards don't actually affect those scores in that way as much as a regular credit card would. Now, I hear this one all the time. I'm going to pay off my credit card that I've had a balance on for years, and then I'm going to close the card and it's going to improve my credit score. The fact of the matter is that actually by doing that, you're going to do the opposite. You're going to make your credit score go down. So when we close a credit card, our utilization essentially goes up, right? Because we have now a lower overall line of credit. That's not good, right? We also shorten our history, our length of history, and our diversification. That card is also now a card that you can't make a payment on time. And as we know, payments on time is the most important aspect of your credit. Another myth that I would like to debunk is that medical bills don't affect your credit score unless they go to collections. If you have an emergency and you end up owing a hospital or you owe an urgent care clinic or something like that, as long as you satisfy those payments, they don't send your bill or your debt into collections agency, then those are not going to hit your credit score and therefore not lowering your credit score. Now, there are a lot of financial gurus out there that will tout that cash is king and that you shouldn't have any credit cards. However, as we've hopefully learned in this video, having a diversified portfolio of multiple different types of lines of credit, including credit cards that are all held in good standing, payments on time, low utilization, all of the things that we have talked about, those will actually improve your credit score. So by not having credit cards, most likely you are actually going to have a lower credit score than you would if you had proved over time that you could properly manage lines of credit through the use of credit cards. Now, the last myth is something that I hear quite frequently as well. Somebody calls me and says, I just paid off my credit card and my score didn't go up at all. I thought that as soon as I paid off my debts that my score would magically go up. Well, the fact of the matter is that it takes some time for lenders or creditors to actually report to the credit bureaus. It will take sometimes up to a couple of months for newly satisfied accounts to actually report to the credit bureaus and therefore hopefully raise your credit scores. Proving a good track record of managing your lines of credit is something that takes time, and it does take devotion over the course of our lives. Consistency is key when it comes to improving your credit score. I hope that this video has helped you understand some new ways that you might be able to tackle your credit score, some new tools in your toolbox for actually improving your credit score, and help you to have a more positive outlook on your credit future. So that's it for today. Check out my channel. Also, check out the Facebook group, Killing the Points Game. I'll put a link in the description to that below. Also, check out the links to Webull and Robinhood in the description below. Those are both free trading platforms that are offering a free stock when you sign up. Please like the video, subscribe to the channel, hit the notification bell so you can be notified when I make future videos. Please comment on the video. I do try to respond to as many comments as I possibly can. That is it for today. Good luck improving your credit scores, and I will see you soon.